Hey guys, it's Steve Lamothe. It's the middle of February, and today we're going to update you on how the market is doing in the first quarter, and most importantly, the biggest changes that we're seeing as we're going into 2022. This video is in regards to interest rates on the rise. I think it's an important announcement to everybody that we know, people who are considering selling, people who are considering buying, and most importantly, those of you who own homes and have not refinanced in the last 2-3 years. So as always, like or subscribe to our YouTube channel or visit us at Homes by Elevate on Instagram or Facebook to stay updated on the recent economic changes in the Sacramento region as it pertains to real estate. Here is the biggest news. Interest rates are on the rise, and they're on the rise faster, much faster than we anticipated. Originally we were estimating rates should be at 4.5 by the end of the year as the Fed combats inflation, rising inflation faster than they anticipated. We are seeing interest rates move and incredibly fast. Listen to this. In December, the average interest rate was somewhere around 2.75. If you were lucky, you can lock a rate somewhere around 2.5. Today, we are locking rates for prime borrowers. This would be really good credit scores and good income at 4.25% to 4.5%. That is a rapid increase, the fastest interest rate increase almost in 10 years in the shortest period of time. What does this mean to you? Well, this means that affordability is going to be greatly impacted. On the same home, let's say a buyer is going to buy a home with a $500,000 mortgage. Today, they are paying almost $200 more per month had they bought that home in December with an interest rate that was almost 1.5% lower. This is going to have great impact as we go later into the year, as more inventory comes on the market and as interest rates tend to increase as we go deeper into the year. My prediction, originally the Fed was talking about raising interest rates 4 times as we go throughout the year quarterly. I would guess that the Federal Reserve is going to raise interest rates 6 to 7 times to try and combat rising inflation, rising costs, and it's moving much more rapidly than they had projected. So what this means to you, if you're considering buying a home today, I would lock your interest rate in now. It is extremely competitive right now because lots of buyers are trying to get in and lock their interest rates as soon as possible. These are people who tried to buy last year and maybe couldn't lock a home in because of multiple offers or whatnot. I would recommend trying to get an interest rate in the 4s while you can. A lot of people have been asking me, well, if rates are going up, won't prices come down? That's not necessarily the case. Appreciation rates have been in the 15 to 18%. As interest rates go down, yes, appreciation rates should in turn come down, meaning prices will rise less slowly or less quickly. But that doesn't necessarily mean that prices are going to come down. So the interest rate matters on your monthly costs and overall long-term costs as you own the home long-term. If you're a seller, I would try to get your home on the market as soon as possible. With interest rates rising rapidly, buyers have this frenzious urge to try to lock their interest rates. And I think the early summer is going to be a great market to sell a home. As we go deeper into the summer and as more inventory comes on the market and as interest rates rise continuously, we may see the seller's market that we've been in for the last 2 years be impacted. Less buyers in the marketplace, it's more expensive to buy, which means there's less buyers per home. This is my prediction. Lock rates while you can, especially if you own a home and you haven't refinanced. If your rate is over 4%, you should explore trying to save money today. Hope everyone has a great week. Hope everyone has a great February. As always, like or subscribe to our YouTube channel. Again, I'm Steve Lamothe with Elevate Realty Group. Thank you so much.